All right, welcome. Today, we are putting on our lab coats and stepping into what I like to call the trader's laboratory. We're going to be experimenting with the absolute must-know essentials of backtesting.
You know, this quote really says it all, doesn't it? Think about it. You would never jump out of a plane without making sure your parachute is going to open. And yet, so many traders throw real money at strategies without ever checking if they actually work. Backtesting? That's you checking your parachute before you take the leap.
And let's be really clear about what happens when you don't test. It's not just about losing some money. It's about all those hours you put in, the frustration, the stress, all of it going down the drain because the strategy wasn't properly checked. It's a preventable disaster.
So, how do we avoid that whole nightmare scenario? Well, we start treating our trading like a science. We step into the laboratory, and our main tool is a disciplined, step-by-step backtesting process.
Now, the manual process is actually pretty simple, but it takes a ton of discipline. All you do is go back in time on a chart, pick a random spot, and then move forward one single candle at a time. No jumping ahead. Every single time your strict set of rules tells you to take a trade, you write it down. No ifs, ands, or buts. And this is basically what your lab notebook is going to look like. A simple spreadsheet is perfect. You log the date, the pair, your entry, stop, and target. And, of course, the result. Every single signal. This isn't just busy work, you know? It's the foundation for everything that comes next. Garbage in, garbage out. Okay, so every good science lab has rules, right? Well, in backtesting, there are two that are completely non-negotiable. If you want results you can actually trust, you have to nail these two: honesty and sample size. First, let's talk sample size. Look, if you only test 20 or 30 trades, your results are pretty much meaningless. A few wins in a row could just be dumb luck. That's why you need an absolute minimum of 100 trades to have any real confidence that what you're seeing isn't just random noise. And this right here is the golden rule. You cannot cheat. I mean it. When you're scrolling forward one candle at a time and you see a setup that you know is about to be a loser, the temptation is huge to just say, I wouldn't have taken that one anyway. You have to fight that urge. You log the loss. This isn't just about getting good data, it's about building the discipline you're going to need when real money is on the line. Just remember this. Your spreadsheet doesn't care about your excuses. It only cares about the data. So you have a choice. Be brutally honest with yourself in the lab, or the market will be brutally honest with your account balance later on. So you've done it all. You followed the rules. You logged over 100 honest trades, and the results look incredible. You're ready to start trading, right? Not so fast. We need to talk about a really sneaky trap called overfitting. It's when your perfect-looking data is actually telling you a lie. Overfitting, or curve fitting, is what happens when your rules are so specific that they perfectly match what happened in the past, but have zero ability to predict the future. Your strategy hasn't actually learned a market pattern, it's just memorized the old price chart, including all the random junk.
So how do the pros avoid this? Simple. They split their data. You have your in-sample data, which is like your sandbox. That's where you build and tweak your strategy. But then you have out-of-sample data. That's the reality check. It's a fresh piece of the chart that your strategy has never, ever seen before.
This is the final exam. The strategy you perfected in the sandbox gets locked in. No more changes. Then you unleash it on the unseen data. If the performance suddenly tanks, you know it was all a mirage. It was curve fit. But if it holds up, well then, you might have just found a real, genuine edge. So once you have data that you can actually trust from a really solid test, you can start to build a true performance profile. This is what moves you beyond just having numbers, to having real, solid confidence in what you're doing.
And at this stage, we're asking much deeper questions than just, was it profitable? A professional wants to understand the character of a strategy. Metrics like these tell you the real story. How smooth was the ride? How much did you make for every dollar you risked? And maybe most importantly, how painful were those losing streaks?
And visually, all of that data comes together in one place, the equity curve. This thing is the ultimate report card. You're not looking for a straight line to the moon. What you want is a relatively steady, upward sloping curve. If you see something that's super jagged and volatile, even if it ends up profitable, that's a huge warning sign that it's going to be a psychological nightmare to trade with real money.
So we'll wrap up with this final question. When it's all said and done, you have to ask yourself,
Have you gone through the disciplined, scientific process to prove you have an edge? Or have you just told yourself a really convincing story that fits the past perfectly? The lab is where you find the honest answer.